In 60 days, someone made $2.28 billion trading oil. That, by itself, is not unusual. Large trades happen every day. What makes these trades different is their timing. Each trade was placed in the minutes before the President of the United States posted to social media about the Iran war. Each one correctly bet that oil prices would fall. Each one was profitable the moment the announcement went public. The regulators have the data. They have the records. They have subpoena power. They have named no one. You have been told this has been addressed, and to be fair, the institutional response was swift. The Commodity Futures Trading Commission opened an investigation in April 2026. Both the CME Group and Intercontinental Exchange were asked to hand over their trading records. Lawmakers from both chambers wrote formal letters demanding accountability. The White House called the suggestion of insider trading baseless and irresponsible. That is the narrative on offer. Investigation opened, denial issued, process begun. Here is exactly where it breaks down. An investigation with no findings is not accountability. A probe that takes weeks to produce no public output, while a fourth suspicious trade is flagged in the same period, is not enforcement. And a regulatory apparatus that has simultaneously watched its enforcement director resign, its legal section gutted, and its staff cut by 15% is not a functioning watchdog. The data does not lie. The question is whether you are willing to read it. To understand how unusual these trades were, you need to understand what normal looks like. Oil futures markets process millions of contracts every day. Volume is distributed across trading hours. Large institutional moves do happen, but they leave a distinctive signature in the data, and the signature of these three trades was anything but normal. The first event was on March 23, 2026. At 6:49 in the morning Eastern Time, approximately $500 to $580 million in Brent and West Texas. Intermediate crude futures flooded the market in 60 seconds. The positions were directional, a bet that oil prices would fall. There was no public news to explain the surge. No announcement, no data release, no geopolitical development visible to the market. 15 minutes later, Donald Trump posted on Truth Social that the United States had been in productive talks with Iran, and planned strikes on Iranian energy infrastructure were being postponed. Oil prices dropped more than 10%. The Kobesi letter, a widely followed financial analysis service, called it the best timed trade of 2026. Then it happened again. On April 7th, traders placed approximately $950 million on declining oil prices. Hours later, Trump announced a 2-week ceasefire with Iran. Oil prices plunged 15%. And again on April 17th, analysts at the London Stock Exchange Group documented this third event with particular precision. Between 12:24 and 12:25 Greenwich Mean Time, 7,990. Brent crude futures contracts changed hands in a single minute. LSEG's own analysts described it as completely atypical for that period, with volumes nearly 9 times higher than normal. 20 minutes later, Iran's foreign minister announced that the Strait of Hormuz was fully open. Brent crude fell from above $100 to around $88 per barrel. 3 trades, 3 announcements, 3 profitable outcomes, the same directional bet, the same timing signature, the same market result. Joshua Mitz, a law professor at Columbia University, examined the data and found that traders linked to suspicious activity achieved a 70% success rate across similar wartime positions, generating $143 million in documented profits from well-timed wagers alone. Craig Holman of Public Citizen told Bloomberg it is difficult to believe positions of this magnitude, placed moments before official announcements, reflect anything other than advanced knowledge. The data does not lie. The question is whether you are willing to read it. Here is what makes this case different from other insider trading scandals. The mechanism is not unusual. Someone with advanced knowledge positioning before a market-moving announcement is as old as financial markets themselves. What is unusual is the institutional environment in which it happened. Financial markets work on one foundational premise, that no participant trades on information the rest of the market cannot access. When that premise holds, prices reflect reality. When someone with access to the president's decision schedule can position against the market before the announcement, the market no longer reflects reality. It reflects the advantage of the person in the room. The universe of people with advanced knowledge of Trump's Truth Social posts on Iran war policy is small. It includes senior White House staff, national security officials, and a handful of individuals in the president's immediate political orbit. The institution created after Watergate specifically to prosecute corruption by government officials, the Department of Justice's Public Integrity Section, has been reduced from 36 career lawyers to 2. The SEC's own enforcement director resigned in March 2026, reportedly after being blocked from pursuing cases touching the president's circle. The agency's workforce is down 15%. Hundreds of enforcement staff accepted voluntary exit packages. The CFTC has subpoenaed records from both major exchanges. It has found nothing it is willing to say publicly. In 6 weeks of investigation about trades that a sitting congressman has described as potentially the largest insider trading case in history, it is worth being precise about what we are and are not claiming here. We are not claiming to know who placed these trades. We are not claiming the president directed anyone to profit from his own announcements. Those are claims that require evidence we do not have. What we do have is the pattern. 3 trades, $2.28 billion, 60 days. The same directional bet, placed minutes before announcements that only existed inside the United States government. A 70% success rate across similar positions. And the simultaneous dismantling of every institutional mechanism that would normally be tasked with finding the answer. The White House issued its denial on the record. That denial is noted. What is also on the record is that 159 federal enforcement actions were cancelled against 166 companies in 2025, more than 30 of which donated to Trump's inauguration. That the enforcement director, who was supposed to investigate this, resigned after being blocked. That the prosecutors, who would normally charge government corruption, have been reduced to 2. And that is the real cost of all of this, not the $2.28 billion, which is large but contained. The real cost is structural. Every market participant who holds a position based on public information and watches it move against them before they understand why is paying a tax they cannot see. The pension fund that buys when the insider sells. The ordinary investor who operates on the assumption that the price they see reflects reality, not the schedule of a Truth Social post that someone, somewhere, already knew was coming. The machinery that exists to catch this has been systematically dismantled. The question is not whether the administration knew. The question is what it tells you, that they built a world where no one can find out. 3 trades, $2.28 billion, 60 days. The regulators have the records. The prosecutors have been reduced to 2. The enforcement director is gone. And the war, the one being decided in private and traded in advance, continues. Markets are only fair when everyone starts with the same information. Someone decided that was no longer a requirement.